the bond market, which is a smart market, it's known as the biggest market, it's the smartest market. They see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. Well, I mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. You know, I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385. So 3,385 on the S&P 500. Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things. Is like, you know, it's one thing to say, oh, you know, if we go into recession, the Fed can save the day by coming in and, you know, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market? So my thinking is that the bond market would have pushed rates up. In fact, even before the Fed started raising rates, the bond market had pushed rates up. But I don't think that the bond market would have gone to this extent. I think the bond market, which is a smart market, it's known as the biggest market, it's the smartest market. They see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. And you're not giving time for it to cycle into the economy. So for all we know, in 3 months to 6 months, when all of these hit the economy, we could find ourselves in a nasty recession. And again, that's what I think the market's getting skittish about. You can see the dollar is skyrocketing again today. That's putting pressure on risk assets across the board. And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous. So I think the key is this, and this isn't being talked about very much in the media, but it's really worth noting, is that the last 2 nights, Japan has intervened in their currency markets to prop up the yen. And what they're doing to prop it up is selling US bonds, right? They're dumping bonds on the open market. But when you sell bonds, what happens to interest rates? it pushes interest rates up even more. So not only do you have a Fed that's saying, hey, we're going to keep raising rates even after this last 75 basis point hike, we're upping our guidance by year end over 4%. But now you have other countries saying, hey, listen, our currencies are getting crushed. It's hurting us. We need to now prop these up. We're going to intervene and then actually add to kind of the pain that we're seeing on the interest rate front. So it is a wacky situation. And it reminds me of almost going back to 2008 where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here. Yeah. And there's no doubt that, I mean, you've seen commodities already coming in dramatically. I mean, look at oil today. Oil's in the mid 70s all of a sudden, or in the mid to high 70s. It was just a few months ago, well above 100. So you are seeing inflationary pressures kind of ease a little bit, but what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%, and they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down, those will come down, but you have that wage issue that is still sticky. Yeah, so I do think that the labor market will start to weaken, right? I mean, it's just the nature of it. Almost every single day, and I pay attention to the stock market and the news. Yeah. There's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, double what they were getting, $25 an hour or so in salary. Now, you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think even the Fed in the statement, they said they don't expect inflation to come down to 2% until 2025. No, I do think high wages are here to stay. I mean, with the inflation numbers, keep in mind, everyone has to keep in mind is that even if we went to a zero inflation number like tomorrow, a price of an apple is still up 50% from where it is. And so you can't just see wages all of a sudden go back to where they were. So I do think where we are in wages is what people get used to. People do not take well to wage cuts. And so I think you're going to see wages stick at these levels for the longer term. Now, they're not going to rise really, but at the same time, they're going to stick here. And again, that's going to be something that these businesses will have to pass through over time. Yeah, that's exactly what it is. And I think it's going to be a lot further out than 2025. And I think it's going to be a very scary situation when again, we do see the Fed continue to raise and push us into a recession, and then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. They had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside.